afternoon. Thanks for tuning in. You're watching Countdown on BloombergQuint Live, India's first digital live streaming business news service. I'm Navneet Saluja D'Souza. These are the top headlines that we're tracking at this hour. Markets trade with strong gains after Monday's consolidation. The Nifty trades closer to its all-time high level after the Nifty Bank and Sensex scaled their respective record highs earlier today. The Nifty Metals Index is the top sectoral gainer. Citi expects global steel prices to rise in 2020. 3 out of the top 5 Nifty gainers are metal stocks. Hindustan Unilever slips into the red after its global parent Unilever cuts its sales growth forecast for the year. And NIT Tech gains the most in a month after the company announced that it will consider a share buyback on December 23rd. Good afternoon, Neeraj. I think it's a quiet day of gains where we're also touching record high levels.
Yeah, nobody's complaining, even if it's quiet, as long as we are doing that, Navneet, which is touching record highs. Yeah, pretty interesting afternoon of trade, or day of trade rather, because we've largely trended higher. It's a beautiful chart because it started off okay, and then it's trended higher. You don't like too many choppy moves, but this has been a large trending day, and if we indeed close well, then it actually augurs well for the next day's session as well. So pretty interesting. Banks may have come off a little bit from the highs of the day, but still no complaints, just about 0.5%, just a little bit of a dip that we've seen in the last few minutes, but that happened somewhere here too, and then it bounced back. So let's wait and watch what happens. But get the heat map up on the screen because there's so many stocks to talk about. We know that the market breadth is positive, won't dwell on that a bit. Lots of positive stocks. Firstly, the likes of the metal names, and must be the Citi report effect that has come into place here, because Tata Steel, Vedanta, Hindalco, JSW Steel, even at the broader end of the spectrum, and I'm sure Devina will talk about it, all the metal names have done well. There is strength in Z Entertainment, so shows a bit of a bounce back. Tata Motors shows a bit of a bounce back, but it's also accompanied by strength in some of the high quality names. So you're seeing HDFC up 2%, Infosys up 2%, ITC up about a couple of percentage points, TCS and HDFC Bank too have some gains. So pretty interesting day of trade really for almost all the heavyweights, save for HUL, which has corrected, and we know the reason why. I think Unilever growth numbers haven't been the most optimistic, and which is why HUL has retreated a little bit, but nothing too dramatic. Sun Pharma marginally off and Gale marginally off, but frankly the day belongs to the gainers, and we're doing so well, and if we hit the highs today, it'll be a rarity that we're doing that without Reliance Industries participating. That is down 0.5%.
Yeah, true. And I was, when you were looking at the intraday move of the Nifty, it's actually a pretty serene day. You've not seen too much, and you've got a good gain of about 0.75%. It's an idyllic situation for the Nifty. But
very interesting terms used. Navneet used the word quiet. You're using the word serene. It's just that kind of a movement today.
You never know what the last half an hour brings for you.
Yeah.
So too early to talk right now. You still have about 1.5 hours of trade left to go. But just a quick glance at what the broader market space has also been doing. Yesterday's session, a lot of crisscrosses towards the end. You saw worsening of the breadth. Coming down to today's session again, you've got the metals and the mining space doing well on the back of the Citi upgrade that's coming in. So Jindal Steel and Power, after seeing a big dip over the last few days, has bounced back about 6.5%. I believe SAIL also here, the Steel Authority of India, which is up 4%. Prestige Estates, this one is a very active stock. So almost on a daily basis, you'll see bigger moves on Prestige Estates, either on the upside or some profit-taking days where you see correction of about 5 or 6%. Today, it's an up day for Prestige. LIC Housing Finance has recovered a bit from yesterday's losses. Dalmia Bharat, Bharat Forge, Indraprastha Gas looking strong. What's looking weak is Mangalore Refinery, that's down 2.5%. Torrent Pharmaceuticals, 1.7%. Sterlite Technologies again. Remember, this one's really, in a sorry state at this point. The last few days have not been kind. Voltas is down about 1.5%. Then you've got the likes of Manapura Finance, which has lost about 1.5% too. From the small cap index, the index itself is up about 0.75%. NIT Tech on the buyback is doing really well, so that's up about 10%. Then you've got Divan Housing Finance, Godfrey Phillips, Hindustan Copper. Everything is up, and even Justal is up about 3%. And the losers, they're on your screen. Trident loses about 12%, but for the year, for the last 12 months, it's down 80%. So really not helping the cause for Trident out here. But also focus on what's been happening in the futures and options space. Namni joins in for that. Namni.
Thanks for that, Devina. Well, the variables are also looking good while we await now Nifty to hit its fresh record high levels, and we are seeing signs of some long position positions coming up on the futures side. If you look at Nifty futures, as you can see on your screen, 5% higher. Premium, of course, in the last 2 trading sessions has been coming down. And for Bank Nifty, I guess major action has been seen there as the open interest has surged about 13% and the premium too has come off to about 38 points. What is supporting this market? We've been highlighting India Volatility Index has been trading around its 3.5 to 4 month low now. So 13.2 is a very, very comfortable level for the bulls, even if the markets were to scale higher from the current levels. What's the range you should watch out then in terms of options data? With today's 80-90 point rally, the base for the market has definitely moved higher right now. In fact, if you look at the 12,100 call, that shed 4 lakh shares. So the call writers run for cover after Nifty reclaims, not only reclaimed the mark today, but also traded above that mark, which did not happen in yesterday's session. And you've got on the put side aggressive writing coming in at the 12,100 put, adding about 22 lakh shares. Traders betting, the writers at least, of this strike, betting that the expiry will happen above that mark. And remember, the base has moved higher because the maximum open interest now is at the 12,200 call and the 12,100 put. In terms of individual stock futures, Jindal Steel and Power, despite of negative news coming in, yesterday was a day of short covering, but now the stocks rallied 6%, 10% higher in terms of OI build-up. It's also one of your top F&O gainers. Technically, it's crossed the 200-day moving average, which could be a positive sign. Tata Steel, of course, the steel stocks are in focus after the upgrade came in, at least for Tata Steel from Citi. There is both price and open interest action seen for this counter in today's trade, and this one is trading very close to its 200-day moving average. It's been erasing its yearly losses. Now it's down just about 15%, 18% higher in terms of OI build-up. Long position seen for Tata Steel. Lastly, M&M Financial has not been following the market moves of late because the stock's down 5.5% in last 2 trading sessions, and with the last 2 days move, the stock's also slipped below its 50 and 100-day moving average. Clear signs of fresh shorting even at current levels being seen for M&M Financial.
Right, that's what we've got in terms of the F&O landscape then. Let's bring in our guests on the show. We've got with us Sudip Bandhopadhyay of Inditrade JRG Group joining us right now. Sudip, thanks very much for taking out the time. It's been a while since we've spoken to you. Lots has happened. I think we last spoke to you sometime closer to Diwali. Let's talk about us being at record highs now, how we're likely to step into 2020. Are you expecting anything different come the next year in terms of market fundamentals?
Well, I think, very clearly few things are changing, and on the global front, I think a lot of good news is coming. Someone may consider not good news, but at least clarity is coming. Boris Johnson winning a very clear mandate in UK definitely brings certain amount of certainty to the entire Brexit process. So we have seen the companies having exposure in UK and Europe getting excited after that win. US-China trade war was a huge sword hanging over the global trade and global markets as well, I would say. To an extent, that seems to be kind of heading towards kind of a settlement, and at least definitely a situation which is better than what we had seen throughout the year in 2019. So these two are significant developments from international point of view. As far as domestic markets are concerned, I think we've been waiting for the fundamentals of Indian companies to improve, the demand to pick up. That hasn't yet happened, but probably we are getting a sense that probably we have seen the worst, or maybe one more quarter of pain is left and things should start looking up after that. So if that's the scenario, then 2020 should definitely be better. Having said that, I will definitely add a word of caution that markets have run up quite a bit, and market always factors in the future. So probably a lot of what I was talking about have been already factored in. We'll have to wait for actual corporate performance to catch up with the multiples as they stand today for things to improve significantly from here on.
All right. Let's talk a little bit more about the metal space. Now, it looks like a lot of interest is coming back into this pocket. We've got a new Citi report which is talking about how the industry is likely to turn around and look much better come 2020. We've seen prices being increased as well. Globally, if the trade talks shape up positively, you'll actually see it take a better turn for a cyclical space which has up until now been ignored badly. Would you be a first mover, probably in a space which up until now has been ignored, but you can start entering into this pocket now?
I'll be extremely cautious in this metal space. I'll tell you what is happening and our reading. While some of the research houses have put out reports recommending entry, I will still be cautious. There is some amount of restocking happening in China, and that's kind of creating some excitement. But I'm not sure whether that excitement is going to last beyond maybe a month and a half. US-China trade war kind of getting resolved, or at least things improving, definitely does help metals. But having said that, these are short-term to medium-term issues. Fundamental issue which remains as far as metals are concerned, and this covers both ferrous and non-ferrous, is what's going to happen to the China demand. Is China going to get back to that scorching pace of growth which we had seen earlier in the current decade? And if there is a significant question mark of China getting back to that kind of growth and consequent demand for metals, whether we are going to see a significant upswing from current levels. Yes, there will be a little bit of pickup here and there, but a significant sustainable pickup in demand for ferrous and non-ferrous metals is still, according to us, not on the horizon. So I'll be cautious. As far as domestic manufacturers are concerned, they had been beaten down and some amount of recovery was expected. We have seen some amount of recovery. The government of India has given them some protection through multiple innovative duty structures, and they were protected to an extent from the Chinese price fluctuations and global price fluctuations. But having said that, I think global demand pickup definitely helps them, and we are seeing a bit of a rally in Indian metal companies as well. That's a welcome rally, but whether that rally will sustain and take them to unseen levels from here on, I'm not sure, so I'll be cautious.
Okay, Sudip, the other bit was the kind of gains that select stocks have done for 2019. And what does that indicate? Now, we were just looking at the data thus far. Of course, there's still about 8-9 days left. But when we are looking at companies which have largely been duds for 2019, auto would feature firmly in that pocket. And two companies kind of stood out for me. One, Mahindra & Mahindra, because it's been the biggest underperformer of sorts in the auto index as well. And two, when I look at the battery makers, which everybody believes will withstand the selling pressure due to the onslaught of EVs as well, Exide has had a remarkably poor year with a 30% downtick YTD. What's gone wrong here, and is it at valuations where people might find comfort?
Well, I think what happened to automobile industry and related ancillaries is a known fact, Neeraj. They had suffered, and they had suffered badly. And the way things are panning out, we believe there is still some pain left as far as the industry is concerned. But somebody has to, if somebody is going to take a long-term view on the industry, I think I will first go and pick up the ancillary companies, and some of the companies like you mentioned, Exide and other battery manufacturers. I think these guys will definitely benefit with the trend shift, and electrical vehicles, electronic vehicle manufacturing will require batteries, and they will require more powerful batteries. So the battery manufacturers will have a bigger per car contribution going forward with the onset of newer generation of vehicles. So as far as fundamentals of these businesses are concerned, I think we are reasonably reasonably confident. They are solid, sound businesses and will be there. It's not that this business will kind of disappear. As far as Excite specifically is concerned, I completely kind of endorse the view that the valuation really looks attractive and can be picked up. One small related news item which I think is flashing all over the news channels today is IRDA probably recommending 74% FDI in insurance. One company which is will definitely benefit eventually is Excite. They have a full-fledged insurance company inside the company, and at some stage there will be value unlocking happening. But you leave aside insurance, even otherwise, I think at current valuation, it looks good. To a great extent, battery companies also fortunes fluctuate based on lead prices, stability in lead prices, and we believe lead prices doesn't have too much scope for shooting up in the near future. Gives us hope that prices will see recovery going forward.
Yeah, that's an interesting bit. I was going to make a segue into insurance versus AMCs as well. Good you brought that up. I don't think too many of the large insurance players will benefit, but Excite certainly could because they get a headway to sell that business. But Sudip, just one question, because you've run both of these businesses, asset management and insurance, in your earlier avatar, in a sense. Just wondering, there are some arguments being presented about how ULIP returns for a slightly medium-term period now will be as competitive as maybe some of the AMC benchmark scheme returns as well. I'm wondering if somebody's looking at a 7-8 year horizon, can insurance companies now be a better bet as compared to mutual funds, because they not only get the insurance protection money but also the savings money, because apparently the last 2 quarters ULIPs have done remarkably well when it comes to attracting capital.
Neeraj, yes and no. I mean, fundamentally, I kind of disagree with the principle that you should mix up these two. If you want to save, you want to invest, I think mutual fund is the way to go. If you want to take an insurance, you should go to an insurance company. But for argument's sake, let's say you want to mix up this. Yes, I think with the cleaning up which IRDA and the industry has done over the last few years, ULIP has become attractive. They are giving decent returns, and the load and other things which the customers were being made to bear, I think that's a thing of the past. So over a period of time, definitely ULIP may give good returns to the customers. Also remember the fact that most of the investments in ULIP get locked in for a period of time. So the general tendency of customers to exit whenever there is an incident or whenever there is a little bit of nervousness in the market, which gets manifested when you have invested in a mutual fund, you can't do that in a ULIP. And I think over a long period of time, that does help in kind of augmenting the returns, and that's pretty much getting played out. Also, the other fact which has happened is the commercial papers which was giving a bump up in returns to the mutual funds, and after ILFS and the other incidents in the credit market, commercial paper by and large is a segment which is not being touched by the mutual funds, and that's the reason why the return from the debt instruments in a mutual fund in a portfolio has come down significantly. They are also pretty much sticking to GSECs, and the GSEC return is what is a pretty standard. They can't do any more esoteric or exotic stuff in their portfolio to enhance the returns, and that kind of indirectly is helping the ULIPs and insurance companies, which were by and large anyway sticking to the standard plain vanilla instruments in their portfolio. They were not resorting to any exotic instruments like what the mutual funds were doing. So I think combination of these two has led to ULIP returns being better in the recent past.
Okay, Sudip, just very quickly, just one quick update. There's some update from the Department of Capital Markets segment about the margin collection, which came in over the weekend, which said that MTM, if the debit will have to be paid within T+2. I'm just wondering if you've looked at it, and does that alter the business mechanics in a meaningful way for a retail investor?
It does, and I think it is probably calls for a relook. If somebody wants to exit from a shares, I mean, why does he need to go and deposit, money with the broker for facilitating that exit? I can understand the risk perspective, but if the individual or the investor has the shares already lying with a depository which is can be verified, there should not be an incremental requirement for depositing cash. So I think certain amounts of the regulation can be relooked at, but fundamentally I think the regulator is trying to de-risk the market and prevent defaults at both the ends, at the customer end as well as the broker end. I think these are to an extent necessary measures to kind of make the market healthier. But yes, certain aspects of the regulation you talked about can be relooked at.
Right, Sudip, stay on with us while we would also address Unilever's news, where Hindustan Unilever's global parent Unilever will miss its sales growth outlook for the current year. The company cites challenges in the quarter in some markets as well as economic slowdown in South Asian countries as some of the key factors. Manis Kreni of Bloomberg News has more details on that.
It's not exactly ho, 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 is it? You just got to look at Electrolux yesterday, down 10.5%. If you disappoint, and that was an idiosyncratic story in terms of what's going to happen in the United States of America. When it comes to the brands of Unilever, all three of us have interviewed Paul Pullman over the years. It's what are the challenges? The challenges are Lipton's tea, black tea is not selling as much. You've got challenges in terms of the ice cream, that sort of nirvana that Nestle ran after. These are the issues within this business, guiding sales to the lower part of the 3 to 5% is the bandwidth that Unilever had set for themselves. And it is that slump in Asia. And I think the language, Anna and Matt, that they use about America is that it's going to take time to recover. And therein lies the point. If you disappoint this market in all of this sort of like, melt-up moments, you're going to get pushed very, very hard.
Yeah, I mean, this is Alan Jope just coming to the end of his first year running this business, isn't he, Manis? After Paul Pullman, we had Alan Jope. Of course, he's been with the business a long time, but he started on the 1st of January 2019. Now, we've come to the end of 2019, and he closes out the year with this slight disappointment for investors. But I suppose when you start to talk about what this last quarter of the year is going to mean for investors, a number of analysts saying in previous conversations I've had about the margin squeeze that it's possible we're going to start to see for businesses globally.
Yes, and within this section, you're right. Alan Jope has been there a long time. I went back and had a look at what Deborah Aiken had to say about the business and in terms of his year so far. And Anna, it's interesting. She talks about the operating margin still being at 20%. The cost cut program pretty much on track. I think what is interesting is perhaps the disposals that may come to play going into next year. And if you look at the roll call of what happened, which was Paul Pullman out, Alan Jope in, and also Maren Deckers making room for a new chairman. So this is undoubtedly setting up 2020 as perhaps another year for change. So I'd advise anybody, go and have a look at Deborah's last slate in terms of looking at all of those issues.
All right, and owing to that development, you had Unilever shares opening with cuts of about 5 to 10% in Amsterdam, and let's see how the opening comes about now wherever the shares are listed. But talking about how HUL gets impacted and what this means. Now remember, the top two markets for Unilever PLC, of course the top contribution comes in from America. 16% contribution in terms of top line is coming from America, and we did see in the last quarter numbers the developed markets growth has not been seen so far, at least in the first half of this calendar year. South Asian, what was cited by Bloomberg as well, South Asian economy is not growing. Now India is the biggest market there, and overall also it's the second biggest subsidiary of Unilever in terms of top line contribution, which is about 10%. So looking at what the current scenario actually means, there was a recent note from Motilal Insti team where they've highlighted the current quarter vis-a-vis the last quarter performance, and they've said there has been no improvement in demand scenario in the third quarter as well. In fact, the the raw material cost has been rising, and that is the palm oil prices, by the way, which have increased about 25 to 30%, at least in the month of December, vis-a-vis the averages that we've seen in the month of October. What's working for HUL? Of course, there is no down trading which has taken place. So premiumization as a theme will continue to support their revenues as well as the bottom line growth. The margins will be maintained. And of course, some other takeaway was the channel liquidity on sequential basis looks better. Of course, there was liquidity crisis. So HUL has been taking effort in order to resolve those problems. But Sudip, come in here. I know ITC was also one of your top picks when we spoke to you during Diwali time. But HUL now, you've got the leader of the pack coming in saying we may just lower the guidance for next. That's the parent company. But the last quarter commentary of HUL was also on the similar lines, where the rural growth now is almost half times compared to urban, which used to be 1.3 times. Do you think it will take little more time for revival in the rural market going ahead?
Yeah, I completely agree with this assessment. I think the ground reality in rural India, hasn't unfortunately yet improved, and rural demand pickup is going to take time. They had a challenge in the urban demand, and rural demand was kind of helping them. And now rural demand itself is weak, and definitely that is getting reflected and will get reflected going forward. I don't think there will be any significant improvement. In fact, margins probably will get a little bit squeezed as far as Q3 is concerned. So we need to be a little cautious. As far as the global commentary, I think it's got to do with significantly what Nestle is trying to do in ice creams in Americas. They have combined a few brands and all that, and that I think is kind of eating into Unilever's market share as far as ice cream is concerned. Tea also, there are some challenges because of the crop failure in multiple geographies, and probably Lipton is getting impacted on account of that. Overall, I think the domestic problems remain different compared to the Unilever US challenges, but overall I think the kind of warning, revenue warning, top line warning given by Unilever should also be taken in the right spirit by the domestic market. Obviously, they didn't see significant improvement coming from India as well, and otherwise that would have got factored in.
All right, we'll leave it at that. Sudip, thanks very much for joining us. Really appreciate you taking out the time.
Thank you.
Remember, we last spoken to Sudip in terms of getting his stock calls sometime in Diwali, and he'd spoken about ITC, he'd spoken about ICICI Bank, he'd spoken about Tata Elxsi. So these are some stocks which have actually been pretty active. ICICI at 539 today, Tata Elxsi about 857. Should see the last 3 months' performance, if at all there's been much of a change out there. But moving on to the space in focus and the buzz at hand, which is the steel space, the metal space. The Citi has come out with a note on the steel industry outlook for 2020. It also expects a rebound in steel demand in FY21. Nikki Mirchandani, she's joining us right now with the details of that report. Nikki, good afternoon.
Hi, Devina. Well, the note is pretty positive overall for the steel sector. Globally, also, they've suggested that they're seeing they're expecting an uptick in demand coming in on steel prices. Minus 2%. Global steel demand up till now has not fared well. It's actually minus 2% down. And if you look at the China performance, that has been overwhelming. In fact, they're way ahead of what the expectation is, at least when it comes to the demand as whole. Volatility, that's expected to ease going forward because China's supply additions would end in 2020. That's the estimate that Citi has put out. Also, not forgetting the fact that there have been winter curbs right now which are taking place in China, because of which you're seeing an uptick there in the global prices. On India demand, they're saying that right now it's expected to be around flattish. It's been flattish or down, but then FY21 they see a rebound, a recovery from the trough, and they're seeing a further uptick coming in even in terms of the steel prices, which by the way, for the month of November and December, both of these months we've seen an uptick coming in. On account of that, given the kind of stress that they're witnessing right now, they've actually gone ahead and upgraded Tata Steel and JSW Steel to buy, while they've maintained the neutral rating. They've upgraded a neutral rating to for sale. They have also raised the target of EV to EBITDA for Tata Steel to and JSW Steel to 6.5 times, as compared to the historical averages of around 6 times that we've seen earlier. Price to book value for sale has been revised higher, and if you look at the target price performance, they've also considerably revised that higher. For Tata Steel, it's a sharp jump coming in there from 330 old target price, it's now to 550, which at this point of time indicates a potential upside of more than 25%. For JSW Steel, there is a substantial uptick there in the new target price, which also indicates an upside of around 21% as compared to the current market levels. And SAIL, that has too been revised higher, and with this latest hike, we're looking at a 10% upside, or the potential upside coming in for SAIL.
Right, Nikki, thanks very much for that. So that's the entire steel pack, which is up and active in today's session. Another pocket then to focus on is the shares of the multinational pharmaceutical companies, which have surged in the Indian markets, even as their domestic counterparts are ailing. Darshan Mehta is standing by to explain why MNCs have the edge and why they're attracting the kind of valuations that they are. Darshan.
Yeah, so Devina, if you're looking at the Nifty Pharma Index, that's down almost 10% from the start of the year. But companies like AstraZeneca have managed to double. Companies like Abbott have done well. They're up almost 80%. Pfizer is up 50%. Even the worst performer, that was Novartis, which was down 4%, has managed to outperform the Nifty Pharma Index. Now, what's working for the pharmaceutical companies on the MNC scale? First of all, the government has exempted patent drugs from a price control for 5 years. And that is something that is giving them impetus to go ahead and launch significant amount of drugs here, even at a lower price. So what has happened is that the focus has shifted to patent drug, and the segment is growing at anywhere between 16 to 17%. Cheaper pricing in the local markets for patented drugs, and that is something that is benefiting them to garner significant amount of market share. Most of the companies have indicated that they're looking to grow their power brands, so they're getting that brand kind of valuation, and the launches are happening from the parents pipeline, which is also helping them significantly. And they are present in under-penetrated therapies, and that is why there is enough impetus on the domestic market when the export market is struggling. Now, a couple of years ago, at least in FY19, the MNC market struggled because of GST, and earlier because of that, because of the NLM issues that came in. But if you see what's happened in the first half, MNC pharma companies have managed to grow at the same pace as the Indian pharma companies, and now they're outpacing them in terms of growth. Almost 15% of the Indian domestic market is made up of MNC, and if you take the unlisted subsidiaries also, that this number actually exceeds more than 20%. So there is significant amount of MNC presence in the domestic markets here. The other thing is companies, investors prefer companies with strong balance sheet, high cash ratios and high return ratios, and that is something that the MNCs offer. They have high share cash in the books, and that is also including high dividend payouts that they give. Even the promoter shareholding is very, very high, and some of the investors would want to play for the delisting thing if that happens. Valuations, no doubt, is expensive. Some of them are trading at FMCG valuations, but given the fact that the market is large, debt-free companies, clean balance sheet, cash-rich companies with a parentage lineage on the MNC side, analysts do indicate that there is dearth of opportunity in the pharma space to play, and that is why the traction in the MNC side will continue.
Right, Darshan, thanks very much for that. So, watching out for some of these MNC pharma names there. AstraZeneca, India trading at 88 times. It's steep for a pharmaceutical company compared to some of its domestic peers, at least. Bringing in Aditya Agarwala of Yes Securities, joining us right now on the show. Along with him, Sacchitanand, Uttekar of Tradebulls is also here with us. Gentlemen, good afternoon to both of you. Let's start off first with you, Sacchitanand, on the index. We kind of almost there, but not there in a sense. What's the take on the index at record highs? What would you do? Is it going to be, so we're going to be in uncharted territory. Would you still take long positions once we cross the 12,158 mark?
Good afternoon. Yes, indeed. In fact, if you look at the overall structure, it has been very strong, and especially at live highs, the market has been trending. If you look at most of the sectoral bets, we have seen a very good sector rotation in last couple of trading sessions, and the focus is again on some of the banking stocks. So definitely, the entire environment is tilted towards a strong bullish phase. So probably Bank Nifty may continue to outperform, but even if you look at Nifty, we expect that 12,220, 12,300 levels could be seen very soon. So with that intention, the stop loss for the trade should be placed at around 12,105 on the Nifty spot, and long positions should still be added. The intraday target that we have been eyeing on is around 12,220. Probably we may see an extended move towards 12,300 in a day or so. If you look at Bank Nifty, 32,150 is the level wherein we recommended adding longs. We are expecting that this move could extend towards say 32,430 in a day or so, and probably from a short-term perspective, the swing that was established in yesterday's trading session, 31,980 should be the stop loss for the trade.
Okay, so that's the advice coming in from Sacchitanand. Buy both Nifty and Bank Nifty, and the levels are there on your screen. Aditya, hi, good afternoon. How do you approach the markets? If somebody who has missed out on this rally, how do you play this now?
So I won't jump and get into it at the moment because 12,150 was the previous hurdle which Nifty failed to take out, and we're almost there in trade at the moment. So there can be some profit taking which can get into the markets. So somewhere around 12,100, 12,085, 90 is the zone where I would like to initiate fresh longs. The undertone remains bullish without a doubt. So we should scale higher levels in the coming trading sessions. But at current levels of 12,140, I'll be a little skeptical in going fresh longs. If somebody is holding on to long, probably I'll look to book out partial profits and wait for markets to claw back a little bit close to about 12,100, 12,085, 90 to initiate fresh longs on the Nifty. In that case, my sense is Nifty should test levels of 12,300 about 370 on the upside easily.
Okay, 12,300 to 370. Definitely with today's move, remember the base for the market seems to have moved higher by 100 points. Earlier we were looking at a range of 11,900 to 12,200. Now that's moved higher by 100 points. But in terms of individual stocks for this afternoon, Sacchitanand, what are you recommending in trade?
Well, the focus is again shifting towards the HDFC twins, and if you look at the recent history, since last 7 trading sessions, HDFC Limited has given a phenomenal return. If you look at the overall performance of both the stocks, HDFC Bank and HDFC Limited, HDFC Limited has been outperforming. It has already scaled by around 8 to 9% in this particular month. But if you look at HDFC Bank, it has been in a constrained range for last 4 weeks. If you look at the overall structure, though it has been in the higher top, higher bottom sequence, but the last 4 weeks have been more consolidative. But if you look at today's price action and the data which is getting generated, it seems that the stock is ready for a breakout, and probably it can catch up with HDFC Limited as well. So we are expecting that there's a fresh momentum which is about to be built up in a stock like HDFC Bank, which could lead the indices further higher. The stop loss for the trade should be placed at 1260, and HDFC Bank should be accumulated. We are expecting an initial price movement till 1295 and an extended target close to around 1340 in the short term. The second call on our radar is Tata Motors DVR. So if you look at the entire price performance in last 2 trading sessions, we have seen a conversion in most of the momentum indicators, and especially if you look at some of the averages, the short-term averages are converging right now. So probably the stock also is gearing up for momentum. We're expecting that this particular move can push the stock towards its 200-day exponential moving average, which is placed somewhere close to 79. The stop loss for the trade should be placed at 73. The stock is quoting somewhere close to 75.50, and still there's a good headroom, and a reward to risk is also very favorable. So fresh longs should be added in Tata Motors DVR as well.
Okay, Aditya, what about you? Your top ideas?
So I have a couple of buy recommendations as well, Navneet. The one is PVR. Stock is on the verge of a breakout from a consolidation. After a long up move, stock went into a sideways consolidation, more of forming a falling wedge pattern, and now it's on the verge of a breakout from that falling wedge pattern. Volumes are pretty healthy in trade today, so I would go long for in PVR for targets of 1900 with a stop loss at 1725. The second stock is IGL. After long underperformance, stock is now again up in trade today, 3%, and volumes are again encouraging in the stock in the breakout that we witnessed from that consolidation that the IGL is showing in trade today. So stock is definitely headed to new highs, new all-time highs. So one can look to buy IGL at current levels for targets of 455 with a stop loss at 415.
Okay, those are some stock recommendations that are coming in, so keep a track of that. The other one is you've got LIC Housing Finance, which is doing okay for itself after dip in yesterday's session. Last 3 months, the stock's been up about 12%. Not a really big mover, but I feel the last 3 months has been a consistent mover of sorts. Aditya, what would you do in terms of a trade here?
I'll wait for a breakout above 445. 445 has been acting as a stiff resistance, as you pointed out, for quite some time. It's not done much for itself, so it's there at the hurdle now, following a decent up move from 420 to 445. If it starts to trade above 445, then definitely there can be more movement on the upside, probably for targets of 475 I can buy.
Okay. Dharmesh Kant of IndiaNivesh Securities is also joining us on the show with his fundamental opinion. Dharmesh, thanks very much for taking out the time. Let's talk about themes now. We're stepping into 2020. We've spoken about a few laggards which could turn, as you could turn the year with some interest from investors, steel, metals in particular, keeping in mind what happens to infrastructure, cement and other commodity plays as well. The PSU theme, now that we're going to be focusing on the budget as well, and ahead of that, divestment will take center stage. What is it that you're watching out for?
Yeah, good afternoon. I think the market is still conducive to have investment bets, and the laggards of 2019 and 2018 would be the ones to look out for. Primarily public sector banks will be in focus because of the NPA reversals happening out there. Around 65,000 to 70,000 crores should be reversed by the end of FY20, and this will add to the aggregate earnings. So a big booster out there. Metals, as you rightly pointed out, metals, cement, materials, these are the key sectors which will be movers. And I think going forward, though the budget will be in focus, but my own sense is we should not be expecting anything from the budget. It will be a non-event. So events will happen outside budget rather than in the budget. So budget will more be a statement of facts and the numbers which the government will be setting on. And divestment, if it goes through a BPCL before that, it should be great for the government. Otherwise, what my own sense is that government will anyway get money, be it through issuance of bonds or diluting their stake in public sector undertakings. But what we are focusing primarily on the businesses which can do well on the backdrop of economy recovering, and that area where we think traction can be there is one is the financials. So public sector banks will be more delta accretive than the private sector peers. And the other area is metals, where Hindalco is a top pick out there, followed by JSW Steel. And apart from that, automobiles, auto ancillary, and few pockets in cements. These are the areas where I think next 3 months the maximum action and traction will be there.
Okay, so those are some top picks coming in from Dharmesh. Just want to mark few stocks from the broader markets also, which are buzzing. I think right from the word go, you had Federal Mogul Goetz, which has been moving higher. So that's, I think, close to being locked in upper circuit or already 19% higher there. Colte Patil is up about 13 to 14%. You've got a TRF, which is up about 13 to 14% in today's trade. And of course, the paper companies have been up and about with hopes of something coming out in the budget for them. TRF actually went up just in the last 15 to 20 minutes there. Dharmesh, hi, in terms of themes from broader markets, of course, something like autos, PSUs is something we've been chatting about, but any particular theme from the broader market, be it something like paper market, quarters of market expecting some bit of announcement to come by, but anything related to this where you would lay your bet on, because these are also the pockets which have not really performed in the last many years.
And rightly so. If the performance has not been there, numbers were also not there. If you look at the earnings, they were dismal in most of these companies in the broader. The small cap segment was very pathetic kind of a numbers they have come out with, and that again corroborates with the fact that economy on the whole was not doing very well. But one has to be very careful when picking up stocks from the broader market, mid cap to small cap kind of a segment. And but I think in the entire space, paper does stand out. Nothing to do with the anything announcements which may come in the budget. Otherwise, also like at 115, 114 when JK paper was trading, I have initiated a buy recommendation on the same. And the rationale was very simple, because paper consumption in India is still 13 to 15 kg per capita, whereas worldwide it is 50 to 16. In US, it is 80 kg per person. And at the same time, e-commerce has been catching at a very faster pace in India. So with a population of 140 crores around about, and e-commerce being the new era of the entire business activity being happening. So packaging paper is the one where the maximum traction will be. And JK Paper has already acquired Sirpur Paper Mills at a very dirt cheap valuation. It's almost 30% of the normal if you set up a new capacity to that 70% discount which they have acquired, and that operating leverage will pay out in FY20 and onwards. So, and they are also taking brownfield and greenfield expansions going forward to augment their capacity with the needs of the industry. Balance sheet is fairly placed, not high on leverage. So, and it's available at 4x PE multiple. With today's price movement, it may be 4.5x. So, again, with ROE of 10-11%, it was a very good buy. The entire industry was looking attractive. JK was standing out. So, that pocket looks do attractive to me. Apart from that, auto ancillaries is the one where one should be looking into. So, like Bharat Forge or even Motherson Sony, one can look into it because the valuations are again very attractive, and world economy is also on the verge of bottoming out. So, these two factors put together will augment well. Currency at the same time is not going anywhere. I think INR will be stuck in the range of maybe at best 69.50 to 72. So this is a trading range for INR which will be very stable. For this year itself, it has not depreciated more than 1.5%. So stable currency with economy picking up, and auto already has seen a 1.5 year of a down cycle. So this also looks pretty well. Apart from that, the few other names which you took, one has to be careful while picking them up. It may, for a day or two, one can see a 15-20% kind of a rally, but that's the lure or the attraction which is there, which should be avoided. Fundamentals should be the parameter or credence. So simple businesses where you have seen numbers coming out, and a mass consumption businesses where the maximum traction will come. Though maybe stock price wise the delta may not be enough, but it will be good enough to keep you happy.
Okay, that's the view on a couple of the themes that Dharmesh spoke about. The other space, by the way, which is doing well, and I guess Aditya had given a buy call on IGL, but also pull up MGL. I think that's hit its 52-week high in today's session. Of course, IGL continues to do well. There you go, it's up 3%, and pull up Gujarat Gas as well. Remember, as a theme now for 2019, these gas distribution companies have given you good returns. If the YTD returns could also come up on your screen, where MGL could be an underperformer because there was an overhang of BG Asia Pacific selling stake in the company. Look at that. Gujarat Gas is up 70% this year. IGL should also come up on your screen, which is also trading around its 52-week high level. 60% returns coming in for IGL. And MGL, I said, could be an underperformer because of the overhang that was there of BG Asia selling stake. And of course, it recovered from the lower levels that were seen in August. And that was the time when the stake sale happened. This year, overall, it's given you returns of 18%. Sacchitanand, first, let me take your view on MGL, which has hit its 52-week high. Technically, would you take a long bet here?
Well, this has been one of our top picks. In fact, near to around 1020 levels, we expected a price movement towards 1090. So this breakout has shaped out really well, and in fact, I would just wait for a while, let it consolidate. But definitely, it is one counter wherein the momentum has just started, and if you look at the volumes and the UI built up now, I think there could be a possibility of an extended move somewhere close to 1130 kind of a zone. So in case if someone is still long in this particular counter and wants to carry it forward, 1050 should be the stop loss for the trade, but definitely not at the peak. Once we see some cool off, I think the price is now put in somewhere close to 1070. So probably in the range of 1065 to 1070 would be an ideal level wherein longs can be added. The stop loss for the trade should be placed at 1050, and then at an eventual final target that we are eyeing is around 1130.
Okay, 1130 can be the target on MGL. Dharmesh, focus on clean energy augurs well for these gas marketing companies as well. As a theme, it definitely worked this year. Do you think the returns will continue even going into 2020?
See, the problem with this space is very attractive, and you have a consistent cash flow with almost predictable earnings trajectory, and gas pricing, though it's been controlled by the government, but still enough margin is left for this company. But when the award for new areas where auction, so as far as my last checking which I did, out of 12, 13 areas which were allotted, 10 went to a particular group and only 2, 3 were outside. So this kind of a skewness, makes it very difficult to for a companies like MGL or IGL to gain traction on the business front. So that is the only problem out there. Because if you see like Adani's, they have been backing, getting all the new areas. So the future expansion or the entire business growth will come from not from new connections but from the new areas which are allotted from them. So if I think some more of a wide kind of a distribution can be done, then this is the area to be in. And the theme for 2019 was primarily because the safe havens, where you can predict the earnings quite comfortably and the businesses were stable, though 10-12% kind of ROEs was comfortable enough. So if you look at insurance companies or AMC companies or utilities, gas utilities, clean energy companies, so these have stock prices have gone up much faster than actual the earnings going up that fast. So the valuation gap has been created. Going forward, I do believe this space is very promising, but if more awards they can get for the areas, new areas, if they come to them, then they are definitely a very great value buy. Multi-baggers from here on. But I am keeping my fingers crossed on most of the companies which are open in this space like MGL or IGL, how much traction they can get from here on.
Okay. I was looking at companies, Dharmesh, which are trading very close to 52-week highs or are trading at those 52-week highs. One of those stocks which I think has gone up today on fairly decent volumes as well is Federal Mogul. It's up about 19% today. Must have been a corporate action, but up 19% on a day like this. What do you make of this specific company? Any coverage here?
No, we don't have a coverage, but I have been tracking this company, and this, as you rightly pointed out, just because of a corporate action, judgment has come in their favor, where they can go ahead. So that is the reason why it has been locked. Maybe 1-2 securities you can get more from here, going to trade for tomorrow and day after, but that is the time to book profit out there. Because the company is very good. There's no problem with the company or the type of business they are into. So all those factors are there. But when you are getting others at a much cheaper price from the same space, why not? And value companies as well, so why not shift there? So to my mind and to my sense, it's time to book your profit in Federal Mogul and get out.
Okay. The other one, which the last few days has continued to do well, is Aditya Birla Fashion. Now, we've seen individual retail companies come out and brand companies do well, but not everything. Arvind Brands, for example, isn't just quite doing anything. Aditya Birla Fashion, a mix of all of this, has done reasonably well. It's trading near fresh life highs for itself, Dharmesh. Any thoughts here?
No, I'm afraid I don't track this company, so I won't be able to comment on it.
Okay. Do you track Safari and VIP, the luggage makers?
No, not
okay,
really,
never mind. But all of these stocks...
They have been into some sort of issue earlier.
No, but all of these stocks somehow have done very well. Safari, for example, with this 3% uptick at 640 today, is trading at fresh life highs for itself too. So this is amongst the companies which have done rather well for themselves. So they were going. Dharmesh, my final question to you. If you've already spoken about NIT Tech, then I want to extend that conversation to some of the other mid-cap IT names and what do you like there? And if not, what's your view on NIT Technologies?
See, when I think the problem with most of the companies, like earlier names which you took, like Safari and VIP and all, the stock may have gone up, but the numbers have not justified the valuations which they have been trading. IT as a basket is looking very, dicey to me. So I am not very comfortable with IT space, be it Infosys, TCS, or a mid cap, or a small cap, any basket you look at it, because. Going forward, the sense which we are getting is the margin contraction. So margin will be a constant pressure on all of these companies going forward. And at the same time, the business traction won't be great enough and the valuations are pretty high. So comfort of, margins not there, it's declining, business traction not there, it may be single digit kind of a business traction, ROEs will be getting reduced. So we as a basket, this entire sector we are avoiding, and what we are doing is we are going on for a risk on trade. So like cyclicals on basically financials, metals, materials, automobiles, auto ancillary. These are the spaces where we are focusing on for the next 3 to 6 months, and that is where we are trying to find out value wise. And this entire space we are avoiding as of now.
Okay, Dharmesh, we leave it on that note. But speaking about the ID pack, one stock which has been moving higher today is NIT Tech. So pull up that stock. It's up as much as 8 to 9%. Your top F&O gainer. Pull up the future as well and see the build up. We've not seen such a big build up in the recent past for at least this stock or any other stock. I think the open interest is up as much as 110%, telling you that there are long positions being built up. Of course, there is news that the board will be considering proposal for share buyback when they meet on December 23rd. So in anticipation, if that goes ahead, if the share buyback comes about, then the street will be watching out at what price will the share buyback take place. But having said that, ahead of that news itself, the stocks hit its 52-week high, Aditya. From current levels, is it poised to move higher?
Yes, I believe so, Navneet. As you pointed out, there's huge long build-up in the stock, and it's visible. From the highs, it's cooled off as well, so I wouldn't mind getting long at 1600. It made a high of about 1645. From there, it's cooled off as well, so it's come off the overbought territory on the shorter-term time frame charts. I'll go ahead and initiate fresh longs at 1600, 1604. I'm looking at a target of 1710 on the upside, which should be met in fairly 1 or 2 weeks' time, with a stop loss somewhere around 1575, 1580 on the downside.
Okay. Well, do watch out for 2 or 3 of these names and how well they are doing. But let's hear out more market voices as well. Structural positioning of the auto sector has placed it on Pramod Guppi's radar for 2020. In a conversation with BloombergQuint earlier today, Guppi says Marcellus investment is more keen on the two-wheeler space as compared to the commercial vehicles. Why? Listen in.
The only new sector I think we'll perhaps look and are looking quite closely is the auto sector. Again, structurally very well positioned, and we have seen across markets, both developed and emerging, it has delivered value for investors across decades. But the harder bit is the cyclicality of it. But then, there's no way we can time it to perfection. In some of these names, we are seeing, stock prices at valuations giving a reasonable margin of safety, and that's where we're looking more closely in terms of the new sectors.
Okay.
I have a follow-up. If you have a follow-up, then continue. But otherwise, I just wanted to ask Devina, because I remember in their earlier role at Ambit, they were amongst the first ones to identify an Ashok Leyland, for example, when it was in the pits. The stock was in the pits, and they took the brave call of going out there. Now, my question is, is CV therefore giving you that option of valuation comfort? And two, knowing the philosophy that you have, you would buy a stock if you can reasonably predict with reasonable accuracy the kind of numbers that these companies will show for the next 2-3 years out. Can you do that within the auto space at large, or the CV space in particular, if you can?
Well, I don't think we're at that stage with commercial vehicles just yet. So we're more keen on the two-wheeler space for now, where I think the drivers are slightly different. It's still, there is a consumption angle as opposed to a hardcore investment cycle recovery, which is what will drive commercial vehicles. And then commercial vehicles, you're also restricted for options. Ashok Leyland is perhaps the only pure play commercial vehicle stock to look at. I think it still remains a fantastic company with the commercial vehicles sector has made a lot of money if you get your timing absolutely right, which is the hardest thing in our job, as you can imagine. But I don't think we're just there yet to see a runaway recovery around the corner in commercial vehicles. But on the other hand, I think two-wheelers will perhaps be an early stage recovery in terms of cyclicality, less volatile in terms of revenue growth and margins. So that's where we are seeing some comfort and some interest building up.
And would the financiers, just wondering, would financiers of two-wheelers also find favor? Because typically ancillaries around that might also gain. Now I can't think of a pure play auto ancillary company which might only be a two-wheeler company. There would be, but I have not looked at them. But financiers would naturally benefit, right? Because, well, two-wheeler financing is arguably a big part of the two-wheeler sales now.
Yes, I mean, and there are some good companies in that space as well, and it's relatively better of the NBFCs given the asset liability mismatch, right? Because two-wheeler loans are typically 2 years on an average as far as duration is concerned, and you can match the liabilities even in today's environment. So that gives you the confidence that both in terms of growth and profitability, you're on a good wicket. So yes, financials will be a beneficiary. In fact, I think even in this slowdown, two-wheeler financials have done all right amongst the few NBFCs out there. And there are some auto ancillaries catering to the two-wheeler space, which will also benefit from a recovery. But then, again, we're not saying that the recovery is next quarter or a couple of quarters away. If you take a 3-year, 5-year view, I think current valuations give you that margin of safety and that comfort that whether the recovery is 2 quarters away, 4 quarters away, it's worth start looking at.
Anyways, bet that way, right? You're not looking to bet it down to the last dollar and at the perfect time. You're buying it for the long haul, any which ways.
Absolutely. I mean, at least we don't believe we have that skill set.
I don't think anybody has that, but okay.
So, but at least we try to get comfort from the valuations.
Pramod, the other pocket that you all have spoken extensively about is the diagnostic space. And I think Saurabh had come on earlier on and spoken about Dr. Lal Path Labs and how positive you guys are on that stock. Dynamics may change if there is one more player that comes in, and talks of Reliance entering this space is pretty ripe. So how does that change for the industry? What changes does this bring about for the industry and players like Dr. Lal Path Labs who have been enjoying this kind of position so far?
Well, I think in the short term there could be some sort of disruption, at least from a sentiment and stock price perspective. But I think this sector is, far from being penetrated, and the growth runway is fairly long. Especially if you take into account the large presence of the unorganized space, right? So if you take the national pan-India players and their share, it's hardly anything. So we barely scratch the surface. Clearly, there is space for more, and I'm sure, given the attractiveness of the sector, given the profitability and the return on capital metrics, you will see competitors entering. The question is, are the incumbents or any of the incumbents have built deep enough moats to sustain that competitive threats? And we're quite happy holders of Dr. Lal's, and we reckon there are moats which will sustain its growth and return on capital over several years to come. And even on the growth front, besides the move from unorganized to organized, I think penetration of preventive tests in India is barely picking up. Right, so from having to undergo a diagnostic test only when you're sick, to now companies enforcing preventive and periodic tests on employees is just barely scratching the surface. So I think the growth runway is long enough and fast enough to even accommodate another player, another pan-India player, if you take into account both the dynamics of the underpenetration of this sector and the unorganized to organized move.
All right, that was Pramod Gubbi there of Marcellus Investment Managers talking about what they like. Moving on, let's also get in Sharad Dubey to talk to us about what has made it to his list of the Fab 4 stocks this afternoon. Sharad, good afternoon.
Good afternoon, Devina. The first stock is Federal Mogul. The stock has hit its lifetime high after Supreme Court dismissed SEBI's appeal of upholding the open offer price of almost 608.5 rupees. So the order grants a kind of a partial relief to Tenneco, which is the acquirer in terms of deposit as per the SEBI regulations. Up next is Kolte Patil Developers, which is up almost 14% after the company came out with this press release stating that it has sold almost 500 units for its Life Republic project in Pune for a booking value of almost 205 crore rupees. Even yesterday itself, Ashiana Housing also did sell around 244 units. So there seems some green shoots, coming in for the residential space. Up next is NIT Tech, which is up almost 8.5% after the company stated that it will consider proposal for share buyback on December 23 itself. And the volumes have been trading almost 24 times its 20-day average. And the last stock of the day we see is HCC, which is up almost 5.6% after Supreme Court has actually allowed Mumbai's coastal project operations to continue. So these 4 stocks are buzzing in the trade today. Back to you.
Right. Sharad, thanks very much for that. So that's what we've got in terms of the Fab 4 stocks of the day. I just want to quickly look at a few more stocks that are moving around in trade today. Starting off first with the stocks like Tata Steel, which is now at 340, very active. Bharti Airtel has gotten to 340 as well, 4.5% higher. for Bharti Airtel. From the mid-cap arena, just want to look at a few more names. Marcellus Pharma, 17% higher. HCC, 5.5% higher. HCC's monthly tally is now northwards of 25%. First Source Solutions, 3.5%, and Just Dial is up about 3% today, so 587 on Just Dial, monthly gain of about 16% for that one. Rahul Arora of Nirmal Bank Securities is also joining us on the show. Rahul, good afternoon to you. We're approaching the end of the calendar year. What is it that you advise?
So thanks for having me. I think it's a tricky call because you're closing the year out at a life high on the Nifty. So I'm not sure whether these kind of returns will be multiplied many-fold from here. But my sense is the budget is going to be a very important document this time around. I think it's going to be very pro-consumption driven, especially in the context to the last few state elections that we've seen with respect to the ruling disposition. So I think there is going to be a very strong thrust towards the consumption side, and I think the budget could actually surprise people positively. I actually wouldn't be surprised to note if the index was to go up even somewhere closer.
We have gone up, by the way. Just to, sorry to cut you, can continue your point, but just to mark that the Nifty's hit fresh life highs for itself. I think it nudged that 12,158 mark once again now. So today we had hit the life highs for the Sensex and the Bank Nifty, any which was in the first 1 hour of trade, and now we've hit life highs for the Nifty as well. So quite a stellar day, Rahul.
Yeah, I think, Neeraj, it's no coincidence it's coming just around the time when the US-China deal has sort of, pacified a lot of people, and the budget consultations with the finance minister started just a couple of days back. So I think there's a lot of sort of euphoria building in. Don't forget that most of the NAV adjustments that have to happen, at least by FIs, will happen this week because most of them will be on leave starting next week. So I'm not surprised to see the kind of thrust that you're seeing that is coming coincidental to two very large data points, which is the budget consultations opening and the US-China sort of taking a back seat. I wouldn't be surprised if you probably make a dash towards 12,250 before the end of the week as well. Because effectively, you do have FNO expiry also that's coming up. So I think a confluence of these factors, the immediate short term, I wouldn't be surprised if you start, sort of see 12,250 or 12,300 this calendar. But, to the point Devina was making a little earlier, the kind of expectations I have from the budget, I wouldn't be surprised if by February you're even knocking on the doors of 13,000 on the Nifty.
Consumption all the way.
I think so, Devina, because I don't think there's anything that the government of India can do to sort of fast track capital expenditure at this point in time. I don't think there's too much they can do on government spending. Because the fisc is where it is after the corporate tax cuts, as we've seen. And we've seen what our trade deficit numbers look like. So I think if you take the proponents of GDP, which is CI, GX, and M, I don't think GX and M are that much in your control. The interesting part is with interest rates being as low as they are, the I component, which is investments, hasn't revived. So I think your entire thrust is going to be on what you can fix quickly, and I don't think anything can be fixed quicker than putting money in the hands of people. And my hope is something happens with respect to tax rationalization on the income front. And if that was to happen, I think it'll probably be a consumption. And when I say consumption, I'm not just talking FMCG. It could be retail-oriented banks. It could be autos. Anything that is consumer-facing could see the positive end of the stick.
So on top of the wish list from budget is direct tax rationalization or something else as well?
I think that's probably the most practical underneath. I think anything else would be asking too much of the government of India, unless you say, I want to go back to a 5% fisc, which was last seen when Dr. Pranab Mukherjee was the finance minister, and we had the stimulus which revived the auto sector in a fairly substantial way. I'm not sure this government probably wants to go the whole hog to that extent because they've just cut corporate taxes, but a little more. I mean, the fact that you've gone from 3.2, 3.3 to 3.9, I don't think people will be too scoffed at a 4.1. So, a little bit of tinkering on personal income taxes, I think, could go a long way. I think it's practical, it's doable. I don't think the other things are, you can have a wish list and it could probably run into pages and pages, but I'm not sure how practical or doable they are at this point.
Rahul, tomorrow is also the GST Council meet. Any expectations from there? Because there are quarters of the market which are suggesting there could be tinkering with the GST slabs.
There might be at the margin of need, but I don't think anything to alter the course of the market. I think one very significant step that was taken was the release of the 36,000 crores to the states that happened a day or two earlier. I think that was a statement that you don't want to upset the apple cart too much, but even if it happens at the margin, I don't think it's going to upset the consumption basket. It's a consumption-driven tax at the end of the day. I don't think it's going to upset it in a material way, because whatever price action had to happen from a product standpoint has happened. I mean, you try booking a hotel room today at a 5-star hotel either in Bombay or Delhi. Those rates are already hiked. I don't think a GST tinkering over the next couple of days is going to have a bearing for the rest of the holiday season, and so also for staples and otherwise. So maybe at the margin, but I don't think it'll be enough to alter the course of consumption, so to speak.
At consumption level, since you've been bullish at this theme for a really longest time, and when you got the torchbearer of this industry, and of course this is the parent company, not the Indian listed HUL, but Unilever, what did you read of the statements? They've lowered their sales forecast for 2020, and they've categorically highlighted developed markets. Of course, America contributes the most to their top line, but when you got India also, which is the second biggest contributor to their turnover, we've seen slowdown happening here. Management commentary also suggesting, I'm not saying we're not growing, we're growing, but the growth rates are not what one had anticipated at the start of the year.
So I don't know how much time I have at my disposition, but I just want to, very quickly, I'll try talking a little faster to explain this, because I think, when you had GST, when you had demonetization that happened in November of 2016, if you were a real estate developer, an auto component or an auto manufacturer, and you were putting up a real estate project or a plant, these are projects that take about 4 to 5 years. So if I was someone who even planned a project in 2016, I was talking about delivery in 2019-20. I think the real pain of demonetization probably started somewhere last year, where you probably got into the last mile funding of a lot of these plants and projects, and that's where you had ILFS blow up and subsequent liquidity issues thereafter. The reason I bring this up is because basically the people who are working at these plants and these real estate projects are people who are probably making 300 to 500 rupees a day, which are the highest, which are the highest marginal propensity to consume. They don't save like you and me. They get it from their left hand, they're sending it from the right hand. The reason levers growth and a lot of other staples have slowed down is because that part of the economy is probably going to take a very, very long time to recover. In that context, on HUL's base, not Unilever's base, if they were to grow at that same 3 to 5% rate, if the entire rest of the industry is growing flattish, I still wouldn't scoff too much at it. The reason being, I don't think FMCG has been a top-line story in India for the last 1 year or even more. It has been an operating margin story, which has actually
they're saying that they're still going to hold on to. They're not cutting profitability.
So that is the most important part, because if you see Hindustan Lever, and I hear this, and with due respect to one of my largest clients who actually put out a note recently saying that FMCG might be in a bubble territory, and I did speak about this to him offline, and I said, you are going to have margin expansion. These guys are sitting on oodles and oodles of cash, and even if they put it in a fixed deposit, you are going to have a very large component of other income. So I'm going to get my 13 to 15% EBITDA. I'm going to get my 16, 17% PAT. I don't have that kind of confidence in a lot of other sectors in India today. So I think these premium valuations, contrary to maybe a couple of points of view, may actually hold out. They may derate a little bit. Maybe a 45 may become a 40, but a 45 ain't becoming a 30, 35. I don't think in this context.
Okay, but I tell you what, is that 12,158 becoming 13,000 by February, what Rahul is saying? I think we need to focus on that for a bit because of the fact that we are at highs, and try and get some opinion about what to do from a near-term trade basis, because the markets are trading at record highs. Now, a question to both our technical experts. From here on, at these levels, 12,159, Aditya, is there a trade on the upside on the Nifty in the near term? It could well be not just a BTST, but a 3-4 day positional trade. Would you take it?
Oh yes, definitely. If it's a 3-4 day trade, I will definitely go long in the markets. Neeraj, whenever a market crosses its previous high, there's an amount of bullishness that definitely gets into the market, and that will kick the markets higher, easily to levels of 12,300 to about 12,350 on the upside. So I would not shy away from taking longs for a week position, for a week's time horizon, looking at the way the markets have been moving. Yesterday, the selling pressure was taken out completely from morning today, and we are scaling new highs, or closing at new highs rather. So this is a very strong sign for the markets indices. I'll go long on Nifty without a doubt, looking at targets of 12,300 on the upside.
Sacchitanand, what about your trade? I mean, what's a fresh trade that you would take? Would you use options, or would you be comfortable with plain vanilla futures with the presumption that you're going long right now?
See, 100%, as we discussed, at the beginning of the show, that if you look at the overall structure of the market has been, very steady, and in fact, if you look at an all-time high kind of an environment, the market is still trending strong. So probably, the levels that we are watching out is around 12,300 initially, and this is what we discussed in the beginning of the show. So 12,100, I think, would be a comfortable base wherein stop losses should be placed and longs should be added. 12,300 would be a review zone.
12,160, 12,161. The going is strong. And I think the point that maybe Rahul made was well taken too. You actually have some tailwinds right now on the global front, and that might only be aiding the performance. The question is, from these levels, if we are indeed to go closer to February, closer to 13,000, you probably need a good showing in the October, November, December quarter on the earnings front as well. Otherwise, on the headline valuation front, we really go high. And we'll talk about that point with Rahul as well. But before that, since we're on the topic of what's happening on trades and deals, it's a great time to get in what dealing room are recommending in the session today as well, on a day when we are at fresh highs. Darshan Mehta is here with his channel checks. Darshan, is there some buoyancy, or is this largely anticipated and therefore in the price?
No, there is a lot of emphasis as far as buying is concerned among some of the dealing rooms, but that sticks mainly to the large cap. But some of the stocks that's been spoken about, one of the stocks which done well today is PVR, and some of the domestic funds are accumulating. The key reason is if you saw one of the notes that came out, Edelweiss came out with a note in terms of the AMFI restructuring that will happen from small cap to mid cap. One of the stocks that they named was NIT Tech, which has managed to rally 10%. Some of the dealing rooms do indicate there is a high potential that PVR probably also could come in on the mid cap end. So PVR is something that's been spoken about. Bharti Airtel has managed to rise almost 4%, and the move was extremely sudden. What we spoke to dealing rooms, and they believe that the fundraising probably will be via warrants, which probably gives the market much more confidence. That's something that's doing well in trade. And Tata Steel has done well today. The entire metals pack, especially the steel pack, did well on the back of what's happening globally, and also the city upgrades that came out. But Tata Steel has actually managed to outperform both Jindal Steel, JSW Steel, as well as SAIL. And dealers do believe that there is a potential of a corporate announcement that could also come in. So that's something that's what we are watching out for.
Right. Darshan, thanks very much for that. That's the dealing room check for you. Market at record highs. Important to get in more market opinion then. Vikas Khimani is joining us right now on the phone line from Carnelian Capital. Vikas, thanks very much for taking out the time. We are approaching the end of the year, and this could not be a better way to end 2019 with. Do things change fundamentally, materially from here on? What's your sense in terms of making fresh investment? What do you advise investors to do right now with regards to individual segments or looking at the market as a whole?
So my view doesn't change materially just because it has hit new high today. I think I have been maintaining that, our economy will be on a slow, steady repair. Liquidity situation, both globally and locally, is getting better with the incremental day. I think Fed's tightening stance, which was there for the last 5 years, has kind of got over, and it has, started, expanding balance sheet. So this is all good, augurs well for emerging market and its liquidity situation. So I think, structurally and directionally, I remain positive on the market. Nothing much beyond that.
Because we've been talking and getting a lot of commentary on what the themes for 2020 would be like. This year was all about the large caps and how the interest flew into some of the private sector banks. Consumption as a story didn't play out a whole lot much, but you do still have those larger names perched at extremely hefty valuations. A new niche theme played out of non-deposit taking or non-lending financial firms that did well. That's insurance, AMC. Is that likely to continue? And do these same themes stack up as winners even come the next year?
I think as the risk appetite, comes back, no doubt in my mind that, the wider market participation will definitely get better. And, this narrow participation was nothing but a flight to safety kind of response. And that was very when there is a risklessness in the market. This is what has kind of changed always changes and more and more risk appetite comes on table. You will see wider participation picking up. And eventually, one has to see how the wider earning participation picks up, which I'm very hopeful about. So I'm net, kind of quite optimistic on the wider market participation.
Vikas, if the Nifty were to scale higher, if 13,000 is the level which the street will be watching out for, where do you think the leadership will come from? Will it be the conventional Reliances of the world, or HDFC Bank, HDFC, or you see other stocks also doing well?
So I think banking being a large part of the way to the index has to lead really. There's no question. So I think BFSI, the entire space, both credit and non-credit, institutions have to kind of contribute to this, and which will be supported by consumption and IT, in my opinion. And these are the three sectors probably would lead pretty much rally from here. Investment sector probably might take a little bit more time till the time we see sort of revival in the investment cycle. So maybe that can lead it in the later part of the cycle.
Okay, Vikas, we leave it on that note. Appreciate you joining us and taking us through your thoughts on the markets at a time when the markets are trading at their record high levels. Bharti Airtel is something which Darshan highlighted, by the way. The stock shot up in the last half an hour or so, and it's been sitting with gains of nearly 4 to 4.5%. It's one of your top gainers. The futures will tell you that there are fresh long positions being taken here. The open interest is surged somewhere about 14 to 15%. Very quickly, Aditya, would you give a buy call in Bharti Airtel?
Oh, yes, this is a top BTST call from my side. Bharti Airtel, one can go long in at current levels for targets of 460, 480 on the upside. Put a stop somewhere around 420 on the downside.
Okay, that's Aditya. BTST. Sacchitanand, what about you? Your closing strategy?
Well, it has, the same stock. In fact, Bharti Airtel, I'm expecting that this move should unfold towards 455, 460 zone. If you look at the overall structure, there's a clear-cut, flat formation which has been completed. We have an engulfing bullish kind of formation. The base is set. So 433 should be the stop loss for the trade on futures. 455 first target. Second target is 460. The other stock idea that I'm liking is Bajaj Finance. So if you look at the overall structure, again here the stock is adding a good amount of open interest. Price is has already elevated. I think 4112 should be the stop loss for the trade, and the overall target from a BTSC perspective is 4230.
The return of the big boy, everybody was saying that 3,900 people may not want to get on, but hey, people are logging on once again. Some of those slightly names on which there was some bit of profit booking are all making a comeback. Bajaj Finance, Bharti Airtel, etc. But Rahul, that question, if you're looking at 13,000, I mean, earnings need to come in the quarter, otherwise those forward multiples just look extremely high.
Just to add to that, almost on a consistent basis, you'll see the profit coming back of the corporate taxes on a quarterly basis, at least for a few quarters now, because the base effect of that will continue to play out. So you will see the bottom line at least show those numbers for the next few quarters.
They will, but I think if you see the trajectory of the last decade, like say 2010 to 2015, if you break it up into two halves, the market actually gave you a 5-6% CAGR and the earnings was a 4-5% CAGR. So I think over a period of time they average out. The correlation hasn't sort of worked out to its entirety in the second half, but I think if what I said comes through, I also do believe that that could be a top for the market for a pretty long time to come. So I don't think the market as an aggregate is going to continue growing as dramatically, because at the end of the day, don't forget that at some point there will be at least one asset management and one or two insurance companies that find their way into the Nifty, which means that the bank weightage or the BFSI weightage is going to go up even further. So, you're getting about 8,000 crores worth of SIPs every month. And, I was just discussing with Neeraj, I think the fund manager's job today is actually not that hard, because, if these are the stocks that have given you the results, it's basically, the winners chase the winners. And, if that's something that you're going to... The interesting part, though, at least what I've seen over the last 1 year in the entire BFSI is there's actually a shift from lenders to non-lenders. So, and I think that's driven the outperformance. I think even if you look at the HDFC quartet, there's been money that's moved from HDFC Limited and HDFC Bank to HDFC Life Insurance and HDFC Mutual Fund. And there's been a reasonable amount of outperformance there. So it also depends on what the index constituents are by then, but I think it's only going to bulge more in favor of the banking system. So you can't do it entirely without the banking system support. Reliance has had a great run. So at some point you'll have to see the revival of the auto sector earnings. You'll probably need consumer to be where they are. And hopefully IT is not as bad as people would expect it to be if, there were some reports that the US might hit a recession in 2020.
That probability started to recede now.
It probably has, and I think if IT was to hold up, because I'm just looking at in terms of sectoral weightages, because at the end of the day, the Nifty today is nowhere reflective of what the broader market or the economy is. It's on its own planet, the economy is on its own planet. There's a huge disconnect with what's happening. But as you rightly pointed out, I think there'll be one artificial propping up of, the one element of artificial propping up of earnings will be sort of the corporate tax cuts that come through. I don't think that's entirely going to go into net profit. You may see buybacks, you may see dividend, you may see some of that put back into capital expenditure, but obviously there will be an element of it that goes in. But to Neeraj's point, I think if you're expecting, say, a market CAGR of about 15%, I don't think earnings are going to compound. I think it's just a function of no other asset class, even today, having that kind of interest as equities do. and therefore you're getting the kind of SIP flows that you are. I don't even think the Nifty falling 1,000 points from here is going to trigger a redemption, because I think people have realized that this is probably the only channelized way of keeping your investments safe. FD rates are on the way down.
I don't think HNIs believe that though. Looking at the last month's numbers.
I don't think such short-term views really matter. I mean, there are some that have. Look, in any portfolio, there's going to be, and I don't mean to talk about any particular person, but since I was talking about fund managers, even some of the biggest HNIs in the country, if you pick up their portfolio, they probably made their wealth on 3 to 5 stocks.
Yeah.
So I think it's...
Give us one top pick then, Rahul, for 2020, from your side.
You'd probably hate me for this, but I'd say HUL. I still think
it's been growing at a steady rate. So
I still think that it's probably going to do. Yeah, and I mean, I do believe you should probably have one life insurance company and one asset management company along with Lever. And I think if there are 3 stocks that you must hold, I think these probably be 3. I don't think I'll be able to sleep peacefully. I'm not talking about. Look, you're talking about either wealth creation or capital protection. I'm pretty sure with A, life insurance, A, asset management, and Lever, my capital would be protected. I wouldn't lose. You'd be pretty much insured holding these. So regardless of what happens, I think so, because I don't think the market is going to sort of change its course on the 1st of Feb. And by the way, I've just been given to inform that the markets are probably going to be open on the 1st of Feb, which is.
We've been hearing that. No official confirmation has come.
I believe there is a BSE release to that
Okay, I was just checking.
It's a bit of a bummer, because. It also happens to be my birthday. That kind of sucks. But no, I don't think it'll alter the course of the market, but I just think there's a lot of anticipation on the consumption side. And like I said in my first answer, I think if it's going to be consumption driven, then you might as well be with the biggest boy.
And we hope you get your birthday gift in the form of direct tax rationalization.
It would have been better off having a day off and sitting at home.
Okay. Aditya, I want to come to you on SBI. And then Rahul, your take on SBI with the entire SR Steel verdict and how that money flows to the bank, but on the stock in terms of a trade.
So I'll not go long at current levels. Probably I'll wait for a dip close to about 325. Then I'll initiate a long on the SBI. Put a stop somewhere around 310 and look for a target of 350, 360 on the upside.
I think this is a turning point for the public sector banks as a whole. I think if this is going to start something, where you're going to look at recoveries of sizable natures. If there's one PSU bank you want to be buying, it's SBI.
Because quarter 2 was really promising.
It was.
Commentary was equally promising. They've delivered at least on one big account.
Yeah, so I think if you look at where the FY18 provisions were for all banks, not only SBI, if you even look at ICICI Bank or Axis Bank and look at what the projected provisions are for FY22 for most sell-side analysts, they're half, which actually means that your profitability is going to compound at 25-30% any which ways. SBI, because of more exposure to projects, is being sort of the lender of first resort, so to speak. Whether you're a private sector company or a public sector company, you do go to SBI for a loan. I think it's going to be one of the biggest beneficiaries. The interesting part, though, is that SBI does capture the life insurance. It will capture the SBI cards listing that's going to happen, and I'm pretty sure, given the listings of HDFC Mutual Fund as well as Reliance, I would not be surprised if in the next couple of years SBI and ICICI Prudential Asset Management both list, because I was just going through ICICI Prudential's some of their ratios. I think they're at a 70% ROE, which is probably second to only something like a Hindustan Lever in this country. So I don't see why, if the flavor is in that in that direction, why these wouldn't list. So one is you go out and buy the subsidiaries. The other is like you don't Kotak, because they're not listed. Kotak AMC, Kotak Life, and I don't think they probably ever will list. But in the case of SBI, exactly. So in this case, if you just want to hold one stock and provisions are going to come down. And hopefully the telecom companies get a bit of a relief from the government of India, because that's probably the only sore spot that we know of right now. The rest of it is going through NCLT, IBC and all of that. Not a bad stock to be holding. Probably the only PSU bank I'd say is worth holding is probably SBI.
Well, good to know that. Rahul, take a moment to thank you for joining in.
Pleasure's mine. Thanks for having me.
Your thoughts. I really appreciate your time. By the way, speaking of banks, just keep in mind, Axis Bank has announced, or rather mentioned at one of the conclaves today, that they want to get into the insurance business as well. Amitabh Chaudhary heads the bank now, so there's a natural flavor out there.
Everyone wants a piece of the pie.
Of the insurance pie for sure, yeah, that's very interesting. But any chance, just before we wrap up, Sacchitanand, one quick mention of Bajaj Finance with the kind of flavor that it is, mood that it is in today. It was your BTST. Would you go in and initiate a long on Bajaj Finserv as well along with?
Well, I think both of the stocks move in tandem, and if you look at Bajaj Finserv, the stock has already given a decisive breakout above 9300 levels. Definitely, on the long side, 9360 should be the stop loss, and I think this particular move can extend towards say 9560 in a day or so. So both are looking fairly positive, and I think even longs can be added here.
Okay, that's the view on Bajaj Twins, but pull up D-Mart, that's also rallied in the last half an hour of trade. It's pipped the 1900 mark. Of course, we've seen Avenue Supermarts trading above the mark of 2000 as well at one point of time. But Aditya, 7% rise in the last half an hour. Would you buy the stock at current levels?
Yes, I mean, I would definitely go ahead and buy the stock. This was on my radar. You just mentioned it. The volumes are extremely encouraging in the pullback that we're witnessing in trade today, 7% up move. I'm looking at a target of 2100 and 2200 on D-Mart at current levels of 1900. It definitely checks the list of top buys for me. So one should look to buy D-Mart at current levels, put a stop somewhere around 1800 and targets 2100 to 2200 on the upside, easily possible in the coming trading months.
Well, stay on, gentlemen. We'll take in closing thoughts, but it's turned out to be a remarkable day because it is turning out what we said it will be great if it does, which is a trending day ending at the high point of the day. Such days are quite remarkable because they set a stage for what could happen the next few days unless something completely untoward happens. So we're ending almost at the high point of the day, 12,178, record highs for all the three key indices, are almost there for the Nifty Bank, but quite a remarkable show today. The broader end of the spectrum, wonder if really it may not have done as well because there was a bit of a late surge in the Nifty today, but however, still in the green, and therefore the market breadth should be positive. I'm really interested in seeing what the volumes are looking like today. But very quickly, what the large caps have done first. Tata Steel, the metal pack did very well, and then Bharti wedged, squeezed there in between amongst the gainers. Quite a remarkable second half for Bharti Airtel today. Tata Motors 2.5, Bajaj Finance, what a showing today. It's bounced back from 1300 like a strong stock would. Infosys, HDFC are amongst the heavyweights, which will be finding a mention on the league table in terms of the weightage companies which have done well, as also TCS, which is up about 2%. Not too many losers, maybe an odd Sun Pharma, maybe the likes of Bajaj Auto and M&M and Titan, etc. And HUL marginally at that. So nothing too much in terms of losers, but a clutch of gainers out there and some very smart moves by the large caps. I dare say, while they're overshadowing the mid caps, a clutch of mid caps have made some pretty pronounced moves today, Navneet.
That's right, Neeraj. In fact, the rally was broad-based, though the broader markets underperformed, but we did see good gains coming in even for the mid-cap as well as the small-cap index today. And of course, there were a lot of gainers when you look at the broader markets. As you can see on your screen, mid-cap index also closing at the highest point of the day. So Federal Mogul Guets, of course, Supreme Court order going in their favor. The stocks closing almost with upper circuit of about 20%. Super House was the other company which rallied in today's trade, buying interest seen here. 12 to 13% gains coming in, and Colte Patil also saw buying interest in today's trade. That stock's closing with gains of about 13 to 15%. And we've been talking about NIT Technology. The board will be considering buyback when they meet on December 23rd. And ahead of that, we did see a lot of buying coming in on the cash side, but even on the future side, there was significant build-up coming in on the December futures of NIT Tech. The steel companies were doing good, and Jindal Steel and Power, the way the stocks recovered even after the negative news which came in from coal ministry yesterday, but still the stocks up 7%, closing around the day's high mark. We just addressed D-Mart, which went ahead on good volumes in the last half an hour of trade, so that's closing with 7% gains. TRF is something else which went up, and as a pocket you had the paper companies doing well. So Orient Paper is something which is closing with gains of about closer to 9 to 10%, 14% actually. On the losing side, Bandhan Bank has been a laggard in the last two sessions. The stocks corrected about 6%, and today also it's closing at days low, cuts of 2%. Couple of pharma companies, Biocon and Torrent Pharma, despite of markets inching higher, we did not see any buying coming in here. Biocon closing the day with cuts of nearly 2%, and Torrent Pharma also down about 2%. Indian Bank among the banking stocks was a laggard today, and something like M&M Financial, the stock was down 4.5% yesterday, and today also you had M&M Financial witnessing fresh shorting, again down 2% in trade. But net, Devina, I think we can't complain when you got at least the benchmarks which are closing at record high levels.
Yes, you have a new record high on the Nifty, which is, I think, 12182.75. So we'll have to wait and watch to see when is the next time we scale this, which could actually happen tomorrow itself. But for today, we're up about 0.5%, 32,140 for the Nifty Bank. Sensex also scaling record highs, so 413 points higher. Individual contributors, this has been done with no support from Reliance Industries, which is actually a good feat. 3 points negative on Reliance Industries. HUL also down by about 2 odd points. But that's not the focus area. The focus area is the gainers and the HDFC Twins and Infosys and TCS from the IT pack, which have contributed the bulk in today's session.
Yep, and IT as a pack actually has made a comeback in the last 3 to 4 trading sessions. But what else is supporting this market is the lower volatility as well. If you could just pull up the India VIX, which has been at about 3.5 to 4 month low, and it's closing at 12.5, 6.5% lower there. And in terms of market breadth, remember yesterday in the last half an hour, we did see more selling coming about, but today I think it was sustained buying seen across the day. So market breadth was also positive. Nearly 2:1 is the ratio that we saw. Finally, the participation. Let's see how the turnover panned out on a day where the markets hit fresh record high levels. On the cash side, it's definitely higher than yesterday, 35,000. And for the F&O turnover, just about close to 10 lakh crore.
Yeah, we could have anticipated a number nudging 40. That's what we've seen in the past on days like this. But considering that it's the fag end of the holiday season, you've got FIIs going on holidays, so you may actually anticipate the volumes being slightly lower, but 35,000, we'll take it. Let's talk about some closing thoughts from both Aditya as well as Sacchitanand. I'll come to you, Sacchitanand, first, and what is it that you're going to be watching out for come tomorrow?
Well, it has been a very strong closing, and in fact, the highlight of the day was that we did not see a lower shadow. And the moment the market started, we saw a small dip, and the recovery was phenomenal. So if you look at the overall structure and especially the indicators, if you look at the RSI, which depicts the strength in the market, it is still quoting at around 62 levels. If you look at ADX, it has inched higher, and it is now placed at around 23, about to give a breakout about 25. And I think these two indicators will be important to watch out in tomorrow's trading sessions, how they are placed on a closing basis. If you look at the price levels, I think 12,220 would be the first level wherein there could be some profit booking, but eventually we see or we expect the markets to move forward towards 12,300 very soon. So definitely a very long and strong day. 12,100 would be critical levels on the lower side. Unless we are holding above this particular level, the probability of 12,300 to be achieved during this particular week remains high.
Okay. Aditya, what about you?
So Nifty definitely looks positive, and if Nifty has to scale higher highs, probably Bank Nifty has to chip in trade tomorrow. So probably Bank Nifty will be an interesting index to watch out in trade tomorrow. My sense is you can have an outperformance from the Bank Nifty tomorrow, looking at levels of 32,450 to about 32,450 to about 32,500, 600 on the upside. That is very much on the cards as far as the Bank Nifty is concerned. Nifty definitely should continue to scale higher, close to about 12,300 in the coming trading weeks.
Right, we'll end it on that note. Thank you very much, Aditya, as well as Sacchitanand. Thank you both for being here with us this afternoon. But we're going to end it right here. A joint report by ICICI Bank and CRISIL has projected retail loan growth to double in the next 5 years to about 96 lakh crores by March 2024. Vishwanathan Nair caught up with Anup Bakshi, Executive Director at ICICI Bank, to find out what's driving this optimism. Listen in.
I think 3-4 things are driving it. One is that there is a supply of credit itself which is driving. So supply of credit itself is creating demand. And why is supply of credit happening? Because there is an under-leveraged section of the society, and the demographic is such that you start with unsecured, then you get into two-wheeler, four-wheeler, housing, etc., etc., etc. Third is that there is a lot of data available, which now gives confidence to digital lenders like us to have better credit underwriting. Because you have bureau data, we have our own account data, we have our transaction data, now we have e-com transaction data, we have GST, we have from other bank, now the accounts aggregator will come. So actually what is happening now, as the confidence level grows, the ability to pick and choose segments which are useful to you increases. And the other thing that is happening on the consumer behavior side is that they know that if they behave well, they can get into formal credit cycles. So I think there is push from both sides. And if you look at the percentage GDP penetration is 12.5%. And this projection shows that it will go to 15.5%. So it's not that it's going overboard, but I think there is unsaturated demand left for credit to meet the aspirations of people.
All right. One question which obviously comes into mind whenever we're talking about unsecured retail specifically is the level of risk that might go up. Now, is that how does that play into your estimate? How do you expect that risk to play out in the next 5 years?
I think on the unsecured side, the issue is that it is also a life stage issue, in the sense that even people like you and me, when we joined our jobs, we couldn't have afforded, we couldn't have taken a home loan. Nobody will give, we didn't have equity. So it is not the issue whether there is demand or not. The issue really is what kind of profile of customers you're getting. Our profile of customers that you're getting who are increasing income with passage of time, or neutral income, or decrease of income. So with a very, very strong salary account franchise, with a very strong liability franchise, we are able to sense that, which customers to pick up. But I agree with you that there could be pockets where it is getting overheated, leverage is getting overheated. Those kind of triggers we get because that customer is coming back again and again into bureau to either take a loan once in 3 months, 6 months, etc. Or there are many inquiries happening on the credit bureau on those customers. So those are customers who are, negative or higher probability risk customers. But for us, we have a very, very large pre-approved base where penetration itself, we are still to do justice to the penetration that we should have had historically. So I think for us, because of salary account, we have a very, very long way to go. But it is a demographic issue, not so much of a risk issue. Risk issue is there because the loss given defaults will be higher, because you have no security. But as far as probability of default is concerned, that is actually completely independent of loss given default. So probability of default is a function of profile of the customer that you pick up. The losses that you have if a person defaults is higher in unsecured. So I think that is the way to really see this market. But I think currently all the markers and all the data that is coming out doesn't point to any issues at this point of time.
Okay, fair enough. But how quickly do you think the banking industry, ICICI Bank also, how quickly do you think you can adapt to the situation if, let's say, some of those markers start showing up?
No, I think the policies can get adapted almost real time, because on real time we keep marking on a we triangulate customer, segment and product. And if we see that it is not happening, we cut those segments, products and geographies. And wherever there is green, we move it. Wherever there is red, we cut it. So it's actually a real-time thing. It's not something that we have to do when we see. If we see stress, slowly, we will intensify on green areas and cut the red areas.
The last couple of questions. Now, there has been some concern with respect to job growth and income growth in general. Does that concern you as a lender, because typically you are going to target some of the salaried customers to push this credit further? What is your view?
So I think the way we see it is that, if they are concerned, it is not evenly distributed, number one. I think India is getting quite, divergent, in the sense that there is a set of economy where the pain is more than other set of economies. For example, all the services sector, IT services sector, etc., not that much of stress is not there. And so it is for us to pick and choose profiles which we think are progressive, where the stress is lower. And in places if we are already underwritten, stress is higher, then we have to ensure that we don't do those businesses, or increase the profile and make it tighter. That's about it.
Last question, sir. Recently, the RBI had ensured 24/7 NEFT services for all customers that are there for banks. To your mind, who does this serve? Because I'm not sure how many retail customers actually use NEFT on a 24/7 basis.
No, actually, you will be surprised how many retail customers use, because the travel has shot through the roof, international travel. Okay, so you will be surprised how many retail customers actually use. Of course, on the corporate sector, they will use. But on the retail side also, we have seen, first few days, but we have seen that a lot of customers use. Actually, Indian customers are quite a traveling kind, and they do 24/7. When in India, of course, you will not do. But many people travel, because you look at all IT services, they all the time travel, they all the time, making. I think it is brilliant for customers. I think it's very good.
All right. Thank you so much, Mr. Bakshi, for joining us on this conversation, and thank you for watching.
Thanks.